Buying things is not where success comes from. It's actually knowing when to sell. And I think momentum investors always forget that. The Fed is still using this 2% inflation goal. And that seems incredibly antiquated to us at RBA. And so maybe instead of 2%, the Fed should be using 3 to 4. There is nothing good to say about debt to GDP and the debt levels in the United States. I'm amazed that people like somehow try to twist this into something that's positive. If technology falls out of bed and if it falls out of favor and goes into, say, let's say some kind of secular doldrum, which I kind of think could happen, might these other sectors of the US economy, other sectors of the global economy perform better, and therefore you'd want to be diversified. If you're investing in an index fund or you're investing in a growth index fund, I think you're making a colossal mistake.
So Matt, today we got 7 clips and we're going to talk about the biggest lessons from our interview with Richard Bernstein.
I always love talking about stuff with Richard Bernstein. I learned so much from him when I was at Merrill and he was the chief strategist. So this is exciting. And as much as I tried to make a bunch of Bernstein Bears jokes for all these clips in my prep, it's a challenge. It's a real challenge, man. But let's do this.
I think the viewers are going to be disappointed if you got nothing. So
I'm going to try
this go here.
I'm going to try.
Okay. It may not hit, but you're going to go with it.
I'm still going to throw it. Yeah, let's do it.
And I should just point out before we start, this interview was done in April. And the goal of these is whenever we do these interviews, there's some evergreen lessons we think investors can take from that. So despite the YouTube commenters who are going to comment, despite me saying this, that why is this interview old and what are you people doing? And you two are idiots, which by the way, I'd probably agree with that last part. But nonetheless, what we're trying to do is come up with the biggest lessons people can take from this. And we're going to use clips from Richard to try to explain those lessons.
And I'll just emphasize the point. Rich was the chief strategist around the financial crisis in the period right after when I was at Merrill. I'm still thinking about stuff on the regular that I learned from him 15, 16, 17 years ago. And there's something about it. And this is one of the reasons Rich is one of my favorite strategists to hear talk about this stuff, because even when he's describing a current situation, he is embedding a timeless and experienced piece of wisdom into that thought. And that's why a clip show like this is truly evergreen.
Let's get into this. The first one has been a painful experience for me, which is this, as a value investor, which is this idea of the narrow market. And there's been so much debate about, is it justified that there's a narrow market? Is it going to change in the future? Is value investing going to finally have its day? There's been a lot of talk about all that stuff. But first, let's play the clip. Here's Rich talking about the narrow market.
Yeah. So Matt, one of the things that I think investors always have to remember, it's fun to be a momentum investor. I would actually call that more trading than investing, but it's always fun to do that. But the problem is with momentum investing, it's sort of like Wile E. Coyote, right? You just keep running and running, and all of a sudden there's nothing there, and then whoosh, and then you get a little puff of smoke at the bottom of the canyon. That's what momentum investing is all about. Is that you kind of just you're the first lemming going over the cliff type thing, and that's when you're a momentum investor. Buying things is not where success comes from. It's actually knowing when to sell. And I think momentum investors always forget that. It's always, when am I going to buy? When am I going to buy? It's so exciting. And they forget that that's not really the key to momentum investing. And so what we all know that the market got very, very narrow. There's no value added in my saying that. Everybody knows that with the Magnificent Seven or the, top 10 or whatever phrase you want to use. But I don't think investors realized what a pessimistic view of the future that was, to have such incredibly narrow leadership. Now, what do I mean by that? So Goldman Sachs, giving credit where credit's due, Goldman Sachs pointed out that 2024's stock market was the most narrow stock market we had seen since the Great Depression. Now, in the Great Depression, it makes sense to see a narrow market, right? Because companies are forget growth, companies are trying to stay alive. And the companies that can grow are like a handful. And so you had very narrow leadership during the Great Depression. Makes perfect economic sense. Now, we could argue all day long how strong or weak the economy was in 2023 and 2024, but unless I missed it, we didn't have a depression. So it was very hard to argue that this was really a fundamentally driven market that we saw. And our argument was that people were missing all these other growth opportunities that were going on around the world, not just in the United States. And I think So where am I going with this relative to your question? What I'm saying is that I think right now that if you're investing in an index fund or you're investing in a growth index fund, I think you're making a colossal mistake because those index funds are dominated by those 7 or 10 names. And those 7 or 10 names may not do very well because there's tons of growth opportunities all around the world, a much broader universe. And the market will eventually understand that and rotate towards that broader universe. So I think the unfortunate reality right now is that growth investing, the way it has been designed or defined rather in recent periods, is very, very, very dominated by those 7 or 10 or 20 companies. And so I think that right now, if you're an investor, not a day trader, but if you're an investor, there are a bazillion reasons to err on the side of value.
First, I just want to clarify one thing before we start, which is this idea. He talks about momentum investing a lot in the clip, and there really are two types of momentum investing. Well, there's one legitimate type of momentum investing and one not legitimate type of momentum investing. So momentum investing, when legitimately done, is not what he's talking about in this thing. Momentum investing is buying things using a proven look back period that's, a systematic strategy that's demonstrated to work over time. So that's not what he's talking about here. What he's talking about here is just the people on CNBC. You see whatever's hot on CNBC, you just buy that, and that's your momentum investing. And obviously, that's, as he says, is not going to probably work out that well for people.
It's like he didn't respect. He was on a nerdy quant podcast somehow. Like he's used to doing actual media spots where people don't care about this stuff.
Well, that's funny. You see it both ways. I mean, the vast majority of people will do what he did there, which is they'll use that word momentum in the other way. But like, I have to be the quant nerd that I am, Matt. Otherwise, what's my value?
You have to be the guy. Okay, so I have to be the culture nerd for a second. I wrote down the Bernstein Bears in the case of the shrinking stock market. That's not bad, right? That's not bad.
That's actually pretty good. So you've actually delivered right from the beginning here.
Yeah, I was thinking if somebody wants to do the mid-journey covers of each of these, because I spent way too much time looking at Bernstein Bears book covers, then ran out of time to turn them into AI images. But something that's nuanced inside of here. So again, the evergreen drop down to this Rich Bernstein idea. I think it comes across in, you can't just look at what's shiny and like chasing stuff in the narrowing market. We know that's the thing. But what he's also saying there is the value over growth, like value over growth, but you can't have that assessment on what's value and without growth without understanding the connection between top line revenue and what the profit margins, what the reinvesting options are for each company in that space. And that's another degree of nuance, kind of like momentum. Just because he's saying value, it doesn't mean he doesn't see growth at a reasonable price somewhere embedded in that value statement.
Yeah, all of us that are value investors have to accept the fact that, at least historically, I mean, the Mag 7 have delivered on the fundamentals.
This is what I'm saying. They've kept up. You can't deny that part.
This is not, I mean, now again, it's a different question of could I have predicted that going all the way back that those fundamentals would have been that good? I mean, a lot of people are thinking they probably could have when they couldn't have. But in retrospect, you have to look at it. You can't be like, this is some ridiculous, overvalued situation like 1999. I mean, these companies have delivered so far. But to his point, the real question is, going forward, will they continue to deliver? And he talks about growth opportunities around the world. And we're seeing that, with international stocks doing better this year. This is a huge question for investors right now, which is, will these companies continue to lead the stock market forward? Or is there opportunities both in value and international stocks, and things may be changing inside the market? It's a huge question for everybody right now.
Not just a huge question, not just maybe the biggest question, because these are the biggest companies in our country, which you're excused. I know you're part of the U.S. and the private island you bought after buying Amazon. I know, yeah.
Yeah. I mean, I'm going to completely cut ties.
But in that context, this is such an important topic because those companies are so important to the U.S. stock market. So we have to care about this stuff, and we have to think about, can they deliver again on the fundamentals that they were able to deliver on before, which you got to look back through history to find some examples of anything even remotely close to this.
Yeah, the other thing you talked about is passive flows. And I think this is an interesting topic, as we've talked about it a lot with Mike Green. And he was kind of on the opposite side of Mike here in terms of he doesn't think it's having an impact. And I've kind of come around. I started where he is and kind of come around to the idea that I do think passive flows are having some impact in making these big companies a little bit bigger. But I still, even those who believe in that, I think would still argue that fundamentals has been the primary driver of why. I mean, I don't think anybody thinks the Mag 7 or the Mag 7 purely because of passive flows and not because their businesses are doing well.
Yeah, you can't subtract those things, which back to that statement of when he's saying value, read the nuance here. He's looking for companies where the price hasn't kept up with the fundamentals. And in many cases with these companies, the prices have kept up with the fundamentals if you zoom out far enough. They might be a little bit ahead, but not It's not just passive flows distorted everything.
I also think, and I don't want to get out over my skis here because I know nothing about this, but I think AI is really interesting from a couple of perspectives with this. One is the idea that will the Mag 7, you could argue they have such a lead in AI that it will just exacerbate their lead they have everybody else. But you could also argue AI enables so much in smaller companies that maybe that threatens the Mag 7. And also, I heard this on a podcast the other day, and I thought it's interesting. Like, someone was talking about the idea that AI is really might be an opportunity in the other than Mag 7 stocks, even the more like boring value stocks I usually talk about, because they may figure out how to use this to improve their business. And nobody's really pricing anything like that in right now. Whereas people are pricing in a lot of stuff with the Mag 7 with respect to what they're going to be able to do with AI. People may not be thinking about the rest of the S&P 500 or smaller cap stocks and what they might be able to do with AI.
I've been talking about this a lot too with clients and people across different industries, with companies, and just the idea of margin expansion can often, or one way to enhance or increase margin is to cut costs. And there are so many industries, quote unquote, boring industries, where if AI can actually be a cost saving, then away from tech, we finally see some of that tech tools delivering in a way that we haven't expected before. And it's going to show up in places like insurance underwriting, or the way the contractor gives a quote on a house, or whatever these other categories can be. Now, that's a really interesting thread that you can't price in because it's not happening yet. But when it starts happening in a meaningful way, you will start to see it getting to priced into areas you didn't think of before.
And I don't know if you know this, like what percentage podcast titling is of GDP, but if it relates to me with podcast titling, I've seen massive productivity boosts. So if that is a large percentage of GDP, we could see, explosive economic growth.
I think you're confusing GDP with JDP again, the Jack Domestic Product that we often say.
Nobody wants to know what goes into that thing. So anyway, we should probably move on here because we've rambled on too much. But the next clip is another thing that people are talking about a lot right now, and things have calmed down a little bit since we talked to him. But this idea of, do tariffs cause inflation? So here's Rich talking about that.
I mean, I've been unequivocal on this point. I think that tariffs, deglobalization, first of all, just the process of deglobalization is inherently inflationary. And the reason why was that globalization, whether you like it or not, I mean, I'm not passing judgment on that one, but globalization was inherently disinflationary because all globalization did was increase competition. And everybody that's listening to this podcast knows that when you increase competition, you put downward pressure on prices. That is not PhD type stuff, right? Well, what deglobalization does is it starts reducing competition. And we all know when you reduce competition, you get upward pressure on prices. And therefore, deglobalization is inherently inflationary. It's a very simple construct. So on top of that, we now have tariffs. Tariffs exacerbate that inherently inflationary force. Why? Because the United States does not have the excess capacity to provide goods to substitute for the tariffed goods. So here's a way to think about it. Here's the example I give everybody. Matt, is anything and Justin too, is anything you guys are wearing right now made in the United States? No, no, there's no way that anything you're wearing is made in the United States. In the last 30 years, the United States has lost, depending on how you measure it, up to 90% of our textile manufacturing capacity. So if the administration puts a 15 or 20 or 25% or 125% tariff on clothes, we have a very simple choice as consumers. We can run around naked, or we can pay 10 or 15 or 125% more for clothes because there's no alternative. There is nothing else we can do. And so that's why tariffs are inherently inflationary on top of the secular deglobalization, which is inflationary too. Now, one thing just to add to that real quick. When I say that it's inherently inflationary, people go, but this is a hair and fire environment, right? So everybody goes, oh, do you mean like 8%, 10%? How much inflation is going to be there? Well, remember, the Fed is still using this 2% inflation goal. And that seems incredibly antiquated to us at RBA. And so maybe instead of 2%, the Fed should be using 3 to 4, something like that. I think that's a reasonable secular outlook for inflation.
First of all, his overall point about deglobalization is important. I think it's important to decouple that from tariffs. If we are seeing deglobalization, I think anybody would argue that that's inflationary. It's hard to argue any kind of deglobalization is anything but that. So I think that's important to separate that out before we have the discussion on tariffs.
I agree completely with that. And I think the way he phrases it is really useful for all sorts of other analysis, which is if globalization was deflationary, then deglobalization is inflationary. And this is kind of a capital allocation problem because when I can go and manufacture stuff overseas or anywhere in the world where somebody says I can do it cheaper inside of my country, it's bringing costs down for the whole pie. As soon as you start to slice that up and say this can only occur in this place, but not in that place, now we have to funnel money differently. We have to change policy to accommodate those capital flows inside of more closed ecosystems, different bottlenecks. And that's always going to be inflationary. The tariff link, I hope you appreciate my Bernstein Bears name on this one. I couldn't decide on the country. Maybe you can help me parse this out. I'm assuming the Bernstein Bears are American. The Bernstein Bears and the mystery of rising Canadian honey prices. Is it Mexican honey prices?
Interesting.
Where might they import their fine seasoned honeys from? I don't know.
I guess Canada.
It seems like Canada would be responsible for honey for some reason. Agave honey? I don't know. Maybe it's something else. But how do you connect this point now to the tariff part of it? Because now in a deglobalized world, you see tariffs as one of the things that create these places where capital gets bottlenecked.
Yeah, and also I think this idea of like thinking about tariffs on an individual basis and how that rolls up is important. And this plays into his idea of substitute goods he was talking about. Like, wasn't it when Lutnick was talking about it, wasn't mangoes the example he used?
I believe it was mangoes, which is
Because I believe we have no capacity to grow mangoes in the United States. Like, it's just not possible, is my understanding. And so therefore, obviously the impact of tariffing mangoes is going to be very different than the impacting something else. But the ability to substitute for the thing that's being tariffed is important. Is there excess capacity? If there is a U.S. company that can do it, do they have excess capacity to take on more demand? Like, there's so many different things. I mean, I don't know if you know this about me, Matt, but I was an undergraduate economics major at the University of Connecticut, and like my supply and demand curves were just exceptional. Like I would change the slope of them. I would like put them up and down. I would shift them. Like it was just, I mean, I don't know where the Nobel Prize Committee was for economics at that point, but they should have been looking at me. But so obviously I'm obviously well qualified to talk about this, but it's a variety of like individual things that rise up to an overall level. And there's no right answer because it changes with every type of good you're talking about.
So what I really want you to do is take that economics degree. And I mean, we got to do an AI mango startup now, right? Like AI mango farming. Right. Like that's the logical conclusion inside of this here.
It is. If we can figure out how to make mangoes. And again, there's going to be someone in the comments who knows more about mangoes than us that's going to inform us why we're wrong about this. But nonetheless, you can substitute any good for mangoes. That was just the example we were using.
But the substitute goods stacked up, I think you have to think about it this way, and you have to think about it in both directions and think about it at scale, because that totally changes the dynamic for, I don't know, maybe I make mango salsa or something. And now all of a sudden, the way that I put this together, it gets really confusing really fast. And you can see how all of a sudden, just like COVID, you disrupt or you take away a supply chain and stuff gets weird fast. And the result is usually there's nothing or there's higher prices or both.
Yeah, and the other thing I think is important with tariffs to keep in mind is most people, I mean, the Fed's kind of talked about it in some of the studies they've done that they're going to look through tariffs, and whether they're actually doing that or not now is a question. But this idea that, I mean, tariffs usually will probably have a positive input on prices, but it's not ongoing inflation because there's a difference between a one-time increase in a price and inflation that goes on forever. And if you think about it, like if you do a tariff and you set the tariff and you're done with the tariff, there probably will be some sort of increase in prices, but it's not something you expect to go on for the next 15 years or something like that, which makes it hard to analyze.
Hard to analyze, hard to prepare around, hard to do capital allocation. Might I also throw in, rewatching this clip reminded me, I wished Jason Buck was on this podcast because he would have been the one person I probably could have banked on the what are you wearing from America right now? That would have literally been like, well, actually, this shirt was manufactured by an 80-year-old man and his 8-year-old grandson who teases the flannel from the alpaca fur that, powered the coal plant in whatever, Allentown or something like that.
And it would have been great if Jason corrected Richard. He's like, Richard, actually, my entire wardrobe right now was manufactured in the United States.
And I'm still thinking, I'm pretty sure the socks that I was wearing then and I'm wearing now, different pair, but still, I'm pretty sure the sock brand is American manufactured. I couldn't pull it out at the moment. Rewatching this clip, awaken that trauma. we need to think about our American-made clothes for future episodes.
And then you got me, who people can tell by looking at me that basically wears the cheapest clothes that can be known to man. So I probably have not worn anything from the United States in the past decade.
Well, because you manufactured on your private island. We know that this is the way you roll.
That's very true. So this next clip gets into another issue that everybody is wrestling with right now, which is this idea of we have a lot of government debt. Debt to GDP is very high. What does that mean for the future? You've got Ray Dalio out there, kind of sounding the alarm bells about it. You've got other people that say, yeah, it's not that big of a deal. So we asked Richard about government debt.
We should all be tremendously concerned about that. There is nothing good to say about debt to GDP and the debt levels in the United States. I'm amazed that people like somehow try to twist this into something that's positive. I can't figure that one out. There's nothing. I mean, think about this. If it was your own personal finances and you were levered up the schnoz, would that be good? Would we all say that's a smart thing to do? Probably not. If we had a company that was levered up the schnoz, would we say that's good for the company? No, we wouldn't do that. And we've learned in the past that when hedge funds or Korean companies, if you want to go back to the 1990s, levered themselves excessively, it led to tremendous volatility in their earnings streams and everything else. So I don't think there's anything good to say about this. However, I'm not sure. People kind of have this notion that there's going to be a day of reckoning, right? We're going to wake up tomorrow. We're going to be an emerging market and nobody's going to want to own our assets. And it's going to be this sudden thing. Like all of a sudden the lights are turned on. And I love when people say that, one, because it's like, we're so smart and the markets are stupid. I mean, that's a huge statement to make, right? That we're all smarter than the market. The markets don't realize this. The markets realize it, I can assure you. And the second thing is that it's not like we're going to wake up and there's going to be a day of reckoning. Rather, it's a slow bleed. And that slow bleed has been going on for really 10 or 15 years already. What do I mean by that? So you might remember that I think it was 2011, the spring of 2011, U.S. Treasuries got downgraded for the first time from AAA. Okay, now let's again go back, take a step back. If I had a corporate bond and it was downgraded from AAA to AA, would it trade similarly to other AAA rated bonds? No, it would not. It would start trading like AA rated bonds, and there would be a little risk premium attached to that yield. Now, if going from AA to AAA, that might be small, but still it would not trade with AAA anymore, right? Okay, so the U.S. debt gets downgraded in 2011. Prior to that downgrade, U.S. Treasuries trade pretty much in tandem with other AAA rated sovereign debt around the world. Sometimes we yield a little more, sometimes they do, we do, they do, back and forth, back and forth, back and forth, depending on what was going on around the world. Then we get downgraded. And I'm going to exaggerate here, but almost to the day that U.S. debt gets downgraded, U.S. Treasuries have sold at a risk premium yield relative to other AAA-rated sovereign debt. And that spread has just continued to grow through time. It's come down a little bit in the last several years, but it's still, I mean, the chart relative to history is something to see. It's like you can tell exactly when we were downgraded. Now, why is that important? It's important because we know that everything all debt in the United States basically trades off the 10-year. We know that mortgages do. We know the corporate loans do, all this kind of stuff. And municipal bonds, everything trades off that. So what's happened is because the United States has already been penalized with this risk premium, that penalty has translated through to all debt in the United States. And so it's not like we're going to wake up and be penalized. We've already been penalized with higher interest costs for being a riskier country. Why hasn't anybody noticed that? Because the absolute rate of interest was so low. Nobody cared, right? They missed the point that it should have been lower, right? But we were being penalized. And so part of our lack of competitiveness is already being felt in that spread that's hindering our ability to raise capital at a cheaper price relative to other nations.
This is one that I struggle with. I don't know. He was definitely not in the Ray Dalio camp of this is about to become a catastrophe, but he was in the camp of there's costs to this. And there's, he talked a lot about the rating agencies, and there are costs to having the debt we have. It's not free.
So number one, my Bernstein Bears title, because I know that's what people are hanging on now to hear. I put the Bernstein Bears and the trouble with Uncle Sam's debt addiction, which I think would be a lovely drop-in character. Uncle Sam, and he's got all this credit card debt or something. It'd be a great issue. I'm just saying.
I wish I was better at podcast editing. I would have him come flying in right now, but I don't think I can do it.
I would take that. I think the point Rich is making is very similar to the point we've heard our friend Ben Hunt make on this too, where the debt downgrades and going back to 2011 when you had the first one, were accelerating this path of thinking of the US as just another country. And when you're just another country and you change the rate of borrowing, it has real costs. And just another country also is a through line back to the deglobalization narrative where you're saying, if we're deglobalizing the world and starting to treat everybody as just another country, then these debt downgrades have real costs over time. And that's not a day of reckoning, as Rich says, but it is hey, this is part of the reality, and it's probably inflationary too.
Yeah, that word slow bleed he used, I think it was a good word, because I think so many people tend to sensationalize this stuff, like, the coming catastrophe or something like that.
I hate a fast bleed. Like the record
Right.
show.
A fast bleed we don't want.
That's bad.
Yeah, no, a fast bleed never ends well. But there can be costs to these things, and they just play out over time. And so that doesn't mean we're going to have a catastrophe. It doesn't mean we're going to have some market meltdown. It doesn't mean like the U.S. is going to whatever some sort of collapse of the United States. It's just going to take time. And I think about the same thing I was thinking about when people were talking about people pulling money out of the U.S. And it's like this is going to be some sort of catastrophe. If these pension funds take X% out, and maybe they will take X% out of the U.S., but they're going to do it really, really, really slowly. And so many of these things in markets just happen slowly. And so this doesn't mean we have, the panic stuff is probably not something people need to be worried about tomorrow or the next day. This could be a slow bleed. The cost, it could be inflation, higher rates. There's a bunch of costs associated with debt. It's certainly something people should be concerned about, but it's not necessarily the coming catastrophe.
The point you made there, I believe, on obviously like the foreign pensions, not just going or turning around. It's not like there's some the small island nation of Jack Forehand might be, net short U.S. equities or something like that. That's their very tactical hedge fund strategy is for how they invest in capital markets. But right, these are slow changes and they happen at multiple levels. Because all of a sudden, if the debt picture isn't attractive in the U.S. and maybe the equity picture isn't as attractive as a local market, these are layered, complex decisions. And that's part of why the slow bleed story weighs in too, until you get that Minsky moment and it all goes to hell. But
it always bothers me because people act like these foreign pensions have like the Jim Cramer red button on MacBook, like the sell button. And they're just like, they're slamming the sell button and like the orders are going in and U.S. stocks are plummeting. And like that's just not the way places work.
It's not the way they work. And it's even not the way that most portfolios in the United States even don't work that way. So like even how many investors probably made, we're going to increase the international allocation. And we were at 5 and now we went to 6, or we were at, closer to global market cap weights. Now we're going to tilt all the way back to it or tilt a little above it. These are tilts. They're not giant all in and all out moves. Useful to remember that too.
So this plays on the point we talked about earlier, but this clip is about international stocks, and international stocks have actually had, I was just looking at today before we got on, like they've had a pretty good run this year. Like they're doing exceptionally well. I know Dave Notting pointed that out in your latest click beta. Like Germany is the country that's raging right now, not the United States. But the big question is, will it continue? And so here, this was back from April, but Rich talking about international stocks and how he thinks about them going forward.
Yeah. So it's a really interesting question because one of the things I try to get our investors to understand is that we at RBA, we don't think like economists, we think like investors. And everybody goes like, well, what does that mean? Isn't it one and the same? No, it's not. So an economist would say, what's the difference between the US economy and the European economy? And then you hear all the stories about slow growth and everything else that's going on in Europe and all these kind of things. At RBA, we ask the question, what's the difference between the US stock market and the European stock market? That's a slightly different question, subtle, but slightly different question. And the answer to that is that Europe doesn't have a big tech sector. And so if you think about what's been driving the US market for the last 2, 3, 4 years, 5 years, it's really been tech. It hasn't been the US economy. It's been tech and tech stocks that have been driving the US stock market. So we just simply said, look, if you look at the world ex tech, whether you're looking at Europe, or you're looking at emerging markets, you're looking at the equal weighted S&P, right? You look at all these other ways that people look at the world. They're all valued very similarly, and their performance has actually been very similar. So, and this may be the if in many people's minds, if technology falls out of bed, and if it falls out of favor and goes into, say, let's say some kind of secular doldrum, which I kind of think could happen, might these other sectors of the U.S. economy, other sectors of the global economy perform better, and therefore you'd want to be diversified around the world? I mean, the simplest way to look at it is to simply say we've got 7 or 10 companies, and then we've got everything else in the world. So if you're going to say everything else in the world, wouldn't that include non-U.S.? My answer would be yes. It would include non-U.S.
The first thing I thought was good here is the idea of the difference between economists and investors. So like there's different ways you view things in the world when you think about them from the perspective of like, what are the things and what might happen? And then how do those things actually impact investing portfolios? Because a lot of this stuff ends up priced in, or, the market already understands that. So I think that thinking about the difference between economists and how this works in a real world portfolio is really important.
This is also important to point out. On this show, we get the difference between econ majors and podcast investors, right?
That is very true.
This is the layer we are bringing to the table today, Jack. I think that's really interesting. And I also think it's important because when you get to the political spectrum, when we start talking about policy, economic thinkers, economic policymakers from the academic world have a different voice in policy construction. And you also have the business interests and the investment interests that layer into that stuff too. This is that thorny network again when we start to think about stuff on the international level.
And this idea of index composition is so important because a lot of people miss this when they think about international versus the US. And I'm a big fan of international, and I've been probably, endorsing international more than I should. But the idea is the US has a lot of technology in there, and technology has been doing really, really well. So that justifies a higher valuation to some extent on the US versus emerging markets. Emerging markets have more of these cheaper value industries, and so do developed markets. And so that has justified historically the fact that the US trades at more of a premium. So you have to sort of correct that out before you say emerging markets and developed markets are cheap. Now, after you correct that out, I still believe they are cheap, but missing that part of it makes them seem cheaper than they actually are.
And when you think about it from, if I'm boots on the ground in one of those countries, or sandals on the ground, or, pick your footwear of choice, boots.
That's what I was on my trip to Dominican Republic. I just got back from. It was more sandals on the ground.
But in the DR, when you were shifting all your capital allocation around and you're, again, net short US equity.
Internet was terrible. I couldn't shift any capital allocation. It was a huge problem.
You couldn't day trade at all. Oh, no. From that perspective too, you go, my capital allocation strategy is different as an investor or a policymaker when I don't have, like if I'm in Europe and I don't know, an Android phone or an iPhone or whatever I have, it's like, well, we don't really make that here, or we don't really totally own the means of production for this thing here. It might get put together here or there, whatever, and it gets to us. But now you have to rethink, what do we need to invest in locally if we need to offset something that comes from another place? We talk about it a lot here, like our fashion choices. We don't talk about a lot here aside from, where the guts of our computers, cars, and whatever else comes from. I put this one on, and I should have made it the DR vacation. I put the Bernstein Bears European vacation, but mostly because all I could think of was a National Lampoon bit. And I thought that'd be a fun crossover too.
The other thing he said in there that I think is important is he was mentioning the idea that if technology falls out of favor, that could be a reversal here. And I think I don't have the answer to that, but I think that is a big question because going back to what I said before, technology is a huge part of the U.S. market. Obviously, maybe it'll become a bigger part of foreign markets, but right now the U.S. has significant dominance in technology. And will technology fall out of favor? It is a big question, and it plays a huge role in this idea of will value and will international perform better going forward, because technology, both of those things are kind of anti-technology at this point.
And my not pushback, maybe a little pushback, is it's still revenue and margins. It's so long as technology is the sector that is enabling above average economic growth, and so long as that margin is also above average, that's going to drive the need for investment and probably the valuation in these spaces. Something else has to happen to change that belief and that inherent function. And hard pressed to say, but is Europe or some of these other countries going to come up with the technology that they need to usurp the Mag 7?
Yeah, but I think in general, you can't argue technology in general. Like the actual technology is going to go out of favor, especially where we are with AI right now. I mean, technology is going to go freaking insane. It's more a matter of like, how are stocks, going back to what I said before about like, are these other stocks outside of the Mag 7 going to benefit from AI? The question is, how is everybody going to benefit from this technology? How are international companies going to benefit relative to US companies? What kind of technology companies will come up in foreign countries outside of the US? And I don't have the answer to any of that, but I think that is a big key to this. And I wish I did have the answer, because I'd probably make a lot more money in my portfolio than I am.
So were we thinking AI Mango, maybe Mango AI? What are we calling our
I don't
tech
know.
company?
Yeah. I mean, first of all, we got to figure out, I mean, I got to obviously, because since ChatGPT runs my entire life now, I got to ask it when we get off, like, how am I going to make mangoes with AI? And it'll come up with a 27-point plan as to how I'm going to do this. And then I'll provide you some funding. I'm not really sure. So I'll get back to you on the next podcast as to how we're going to do this.
Okay. Just want to have my backup plan here so we can run this right.
So this is another clip about passive investing here. And this I thought was an interesting point in terms of passive investing in indexes. I mean, everybody associates passive investing kind of with one index, but that's not necessarily the truth. So here's Richard talking about passive investing.
A couple of things. Number one, Jack Bogle was one of my heroes when I was like in business school. And I was fortunate enough to meet him a couple of times during early parts of my career. And I have an amazing amount of respect. I mean, I think he was one of the, there aren't as many as people think, but he was really one of the forefathers of modern investing. There's no doubt about that. And however, one of the things in one of the books I wrote, one of the things I pointed out was that Jack would never tell you. He would say, go buy an index. What he would never tell you is what index to buy and when. And that's actually a pretty critical question, because, if you had bought NASDAQ at the peak of the bubble, it took you 14 years to break even. But if you had bought an emerging market index fund, you would have been fantastic. You would have had a great old time. Or you bought the Energy Spider, you would have had a grand old time for that decade. But if you bought an S&P index fund, you had negative returns for a decade. So to say, I'm just going to hold an index fund, it doesn't quite always work that way. And right now, when we've got such domination of such a narrow market, buying an index fund basically gets you exposure to these tremendously overvalued stocks and doesn't get you exposure to everything else. So I think one wants to be a little careful about that. I've always taken issue with the notion that index funds drive narrow markets. I don't think that's actually right, because if you're buying an index fund, the index fund buys everything in proportion. It's not like they're buying just the Mag 7, and therefore the Mag 7 are going up relative to everything else. If you're buying an index fund, it should be neutral relative to everything's out there. And now one could argue that the less liquid companies there's all kinds of ways you can argue against it. But I don't think in a grand scheme of things, that's what's actually going on. I think it is much more that people really took a speculative liking to a very narrow universe of companies. So I'm not against index. I think right now is a very bad time to hold like an S&P index fund or a growth index fund. I said that before. But, if you're talking about something like an equal weighted, or you're talking about emerging markets, you're talking about Europe, you're talking about ACWI, ex-US, there's plenty of index-like products that you could invest in and probably get pretty good returns.
Yeah, this idea of like, what do you hold? I mean, obviously, if you're truly a passive investor, you hold the market cap weighted, of everything in the world, which you can't really do because you can't hold the private assets. But even in the public markets, you just hold everything market cap weighted. And then that's basically what most people have been doing, holding the S&P 500, which is most of, the total market, at least inside the US. So people have been doing that. But the idea is there are a lot of indexes out there, and you can be a passive investor and say, I want to invest passively, but I don't want to do it that way. I want to do it in a different way. And maybe there'll be more opportunities for that going forward.
So I called this one the Bernstein Bears and the Wise Old Index Fund. I think the messaging here and what Rich is trying to say and what you were just saying is like, you got to just think more broadly. We talk about indexes, we talk about passive, and we talk about them in terms of like, everybody's just talking about the S&P and nothing else. And it's like, even inside that, there's variations, because we can slice and dice things all sorts of different ways. You could have the S&P 500 market cap weighted fund. You could own all the sector funds. You could own some of the sector funds and not some of the others. You could own equal weight S&P. You could own international. You could own all this stuff. It's a big, complicated, messy system around this. And just the idea that people are net savings into some of these categories and how they put money to work, it's a complicated reality. It's one we have to recognize, but it's not the be all end all explanation to everything.
What's been interesting to me is this idea that more people are using total market versus components of total market. So if you think about it, like if I have total market fund as one fund, or if I have S&P 500 and Russell 2000, my behavior is a little bit different with that, because as small caps are underperforming and I'm rebalancing, if I have Russell 2000 S&P 500, I'm buying Russell 2000 as part of that. If I have total market, I'm doing absolutely nothing. So Mike Green has talked about this, and it's just interesting to me, like how that may have changed the market, that people are just getting this overall thing and maybe not the components of the thing.
I think about this all the time. And I think about this all the time in the context of when people build globally diversified ETF or index fund portfolios. Because it's the same thing. Now, all of a sudden, your changes at the margin, your rebalance decisions and timing, they influence all this stuff. And there's just no way to aggregate all of it to understand it unless something gets put into a funky corner, like thinking Mike Green and the VIX ETN stuff. Unless you put stuff into a funky corner, a lot of this is just a big, complicated mess.
And the other thing I thought was interesting was this idea of how this intersects with the narrow market thing we talked about before, because these companies are a huge part of the S&P 500 right now. And as a passive investor, do you ever get to a point where you are concerned about, I'm overly concentrated in a small group of companies by owning an index, and I should maybe own something on the side that's based on fundamentals, or, maybe what Research Affiliates is doing with fundamental index or something like that? Does it ever become, obviously it's worked out really well and there's huge arguments in favor of it, but do I ever think I need to supplement this or something because I just have so much of my weight in this small group of companies?
Yeah, it's interesting. And I think the counter of that was talking to people who have the passive portfolio, I don't know, like a year or 2 years ago. And it's like, well, should I have the passive portfolio and then own more NVIDIA on top of it, or own more NVIDIA 7 on top of it? And those are real conversations, and they're conversations worth having and asking when you're seeing anything put up the numbers that it's putting up the way some of those companies were. But there's a counterbalancing conversation in each side. And that's often where you just have to figure out what works for you and what you think the future looks like.
Yeah, and to counterbalance myself, these companies are obviously that big of a part of the index because they're doing really, really well. They've kind of become the consumer staples of the new era. So it's not like I have a huge portion of my portfolio in these crazy risky companies. I have my huge portion of my portfolio in these like economic powerhouses. So the risk is obviously less because of that.
Yeah, once people stop eating steak and only eat mangoes as their primary source of nutrition,
Which they will
protein,
after our AI gets going.
which they will once we get this AI booted up. The world is going to be a different place, Jack.
Yeah, I can't even think through the implications of that. They're going to be so massive. So on to the next clip here. The Fed is something obviously people have been talking about a ton, and we ask our guests all the time about the Fed. So we had to ask Rich about the Fed. So here's Rich talking about, again, back from April, but pretty similar to what's going on now. Talks about the position the Fed is in.
So first, let me preface this by saying I don't envy the Fed. I'm about to be very critical of them, but I think it's real easy to be an armchair Fed watcher than it is to be the Fed itself. And I admire them for their guts and gumption, even though I don't agree with a lot of the things they do. It's two separate issues there. So I don't want anybody to think that they have an easy job. They certainly don't. That being said, a couple of things. I used to teach in the grad school at NYU, and one of the things we used to talk a lot about was leading, lagging, and coincident indicators. So a leading indicator is one that actually leads GDP. A coincident indicator moves in tandem with GDP, and a lagging indicator moves after GDP. And so what I always used to try to point out to the students was that investors, for some reason, have an amazing fascination with lagging indicators. I just don't get this. It's one of the things that when we go out as a firm and we market to people, we talk about the importance of leading indicators and how we follow them, blah, 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 blah. But everybody talks about lagging indicators. So what are kind of lagging indicators? Well, the CPI is a lagging indicator. The unemployment rate is a lagging indicator. Think how much attention those two get, and they're lagging indicators. What's another lagging indicator? The Fed. The Fed is a lagging indicator. And Janet Yellen used to talk about this. She used to say, we're going to become data dependent. Now, I always loved that phrase because what were they before? Were they just winging it? And all of a sudden, this is something new, and now they're data dependent? No, they were always data dependent. But what that statement really means is that they were going to get the data, they were going to analyze the data, and then they were going to, keyword, react to the data. That's the definition of a lagging indicator. So whereas Wall Street always treats the Fed as being the initiator of something. At our firm, we've always treated them as the reactor, not the initiator. And so I think that's very important for investors to understand that, maybe if you're a hedge fund and you're day trading, I get the Fed announcement is going to be very important. I understand that. But from an investment point of view and a portfolio construction point of view, you cannot treat the Fed as a leading indicator. They're very much a lagging indicator. Second thing is, I think the Fed right now is kind of caught between a rock and a hard place. And that's what I was saying before. This is a tough job because the Fed was spoiled for many, many years by that deglobalization, secular disinflation, deflationary force that was put on the United States. So we all thought that like a lot of the Fed chairmen were fantastic. They couldn't go wrong because even if they completely messed up, you saw this massive disinflationary force keeping inflation under check. Well, as deglobalization takes effect, the Fed's job gets harder now because now the secular trend isn't disinflation, the secular trend is inflation. So they can't play the hero anymore. In other words, they can't, the whole notion of the Greenspan put and all this kind of stuff, the Fed put that people like to talk about, how when the market goes down, the Fed saves the day. The Fed can't really do that now because inflation expectations are rising. Secular inflation may be rising. That handcuffs them a little bit. So they're caught between a rock and a hard place in that the economy might weaken because of tariffs. We may hurt the consumer on that. But at the same time, inflation expectations are going up. Which do they choose now? They have to make a choice. Do they want to fuel inflation and maybe save the consumer? Or do they want to fight inflation and maybe cause a recession? Now they're going to have to earn their keep. It's a much different world to be a Fed chair than it was 10 or 15 or 20 or 25 years ago.
The first thing I always like when people answer this by acknowledging that the Fed has a tough job, because we get so many guests just railing against the Fed and what a catastrophe this is. And I can't believe they're not doing this. And like, this is freaking hard what they're trying to do right now, especially, in the world we're in now, which we'll get into in a second, but they have a hard job.
It's the ultimate Monday morning quarterbacking move, right? To just rank on the Fed and not acknowledge, like, I do not want that job. As many things as I want to poke fun at and criticize politicians for, I can say in earnest, I never want that job as pure misery. My Bernstein's book title for this one was The Bernstein Bears Meet the Money Tree Keepers. And I have this idea, these kind of like hooded figures. And I'm also thinking of, it's in one of did you read the Hitchhiker's Guide to the Galaxy books? Are you familiar with that series?
I didn't.
There is a phenomenal thing in the third or fourth book where he imagines this interstellar economy where the leaves on trees are the actual currency for the society. And so because of the leaves, there's too much inflation. So they go on this mass deforestation thing. And then there's like no more trees on the planet or whatever else. And he just takes it to the nth degree. He's not even an economist, but Douglas Adams, what a friggin' genius. All right, so let's go serious stuff. Him breaking down the leading, lagging, and coincident indicators idea, this is something that always drove me friggin' crazy. Because it's like, there's nothing about the Fed that says the Fed is not a hedge fund that is going out in some leading, like a macro hedge fund with some leading thing. Like, we're going to get in front of this. It's always a reaction function. Why do we seem to forget that constantly?
Right. I mean, the idea is, they're measuring, they're looking at growth, they're looking at inflation. Those by definition are lagging indicators. And this is a weakness of the Fed. I don't know that you could do it better. That's a different debate, but
correct.
This is part of the Fed is data dependent. And when they're data dependent on lagging indicators, they're going to be late. That's just the way it is. Now, the other question though, is obviously the word leading indicators, I think is to some degree misleading because people think they actually tell you what's going to happen in the future. They help you figure out what's going to happen in the future. But if they told you what was going to happen in the future, it would be a much easier job. So they're not necessarily leading indicators, but they give you a better idea maybe than the lagging indicators.
Right. Or at least they're indicative of something else is going on that's not going on where I am now. Like something else is happening in front of me, and it might not be the thing that's going to happen to me, but it's giving me a reason to pause and acknowledge what's happening now. We want the Fed in somewhat of a reaction function to say something that's actually happened, not something that's just kind of sort of happening in some corner, something that's actually happening they respond to. But that also changes the activities of behaviors and how we think. Michael Hartnett, one of Rich's former colleagues, he had I want to say it was It was like you always sell the first rate cut. And it was this idea that when the Fed starts cutting, they're probably going to have to cut more than they expect. There's very few examples in history where if the Fed has finally gotten to the point where they're like, well, we should cut rates, you should probably start to be scared, because as a lagging indicator, they probably should have started doing that already. And now they're going to have to do it for a while till we start to get to that point where the rate cuts are going to stop.
Going back to the idea of how hard their job is, like if I'm the chair of the Fed, at a certain point, I'm going to be sitting in a suit in front of Congress, and I'm going to have to explain what I actually did. And so if I have to do that, I probably want to have like inflation and GDP, those lagging indicators. I probably want to have some data in there that explains what I did versus something else. So and I don't know if there's a better system. There probably is, but you have to understand why they do what they do based on the way the system works.
Right. And these are the same Congress people who are confused about, social media and what the kids are putting on Facegram, that we're now going to go explain these complex policies to. Yeah, whatever the hell they say. So it's complicated. You have to defend it. And this is where the data becomes so important, and why the evolutions in the data and tracking the languaging of the data becomes one of the only things to help people like us half understand what's going on in the world.
And obviously, Matt, when our mango thing goes awry, we'll probably be in front of Congress too. So we probably got to be ready just the way the Fed is.
Once the mango is treated as the reserve currency that we know it to be,
or once it grows into some like crazy thing that starts attacking everything around it or something, because obviously we know what we're doing. So that's probably what's going to happen. But anyway, the only other point I want to make on this is the idea of the dual mandate is really important right now, because there's always been a dual mandate, but there really wasn't a dual mandate for a really long period of time, because the Fed could always cut without having to worry about inflation. And so that made it really easy to deal with downturns. And this is the first time I can remember, like in my career, where for an extended period of time, they actually have to worry about the dual mandate, and they can't just cut and not worry about what happens with inflation.
The dual mandate, and then what that also suggests, and he didn't say this here, but it's this idea of like the Fed collar that comes out of it, right? And this is the reality we're living right now. It's like, well, where's the Fed put? Well, where's the Fed call? Where's the Trump put? Where's the Trump call? These are all questions that start to enter into the equation, and we start to think about, what does this mean going forward, and what are the ways these communication policies impact markets? The impact's very, very real.
So this last one, we asked him our standard closing question, which is, if you could teach one lesson to the average investor, what would it be? And here's what Rich said.
So here's what I tell everybody. And I wrote a book about this 20 years ago or something. It was called Imagine this was 25 years ago. I wrote a book that was called Navigate the Noise, get the subtitle, Investing in the New Age of Media and Hype. That was 25 years ago. Okay. So more appropriate today than it was 25 years ago. And what the book basically argued is that building wealth is not difficult. It's actually very easy. So why don't people do it? And the answer is that there's always a siren song of something new, better, sexier, something. And to continue on the Greek mythology there, and then people go and they crash on the rocks, right? And so why don't we know that certain things are critical? Like, we know that diversification helps you build wealth. People don't want to do it because now there's the Mag 7, something new, better. We know that compounding dividends is a fantastic way to build wealth through time. People don't do it because who wants dividends? Oh, that's so boring, right? Why do we want dividends? Things like that. So I think, my advice to individual investors has always been to keep to the straight and narrow, right? If you want to have a little puddle of money over here, that's your more speculative play money, that's fine. I get that. I mean, we all do that. That's fine. I have mine. I'm not going to share with you the stuff that I blow up in like everybody else, but that's fine, right? But the bulk of your wealth building should stick to the straight and narrow, and just keep it simple. Think about the rules, and I just think people don't do that. They always think there's a get rich quick, and there's never a get rich quick. It just doesn't work.
First of all, Matt, I love that he wrote this. What was the book called? It was like Investing in the New Age of Media and Hype, and he wrote it 25 years ago.
Yeah.
So it just goes to show like that we're always thinking about this like we're in some new age or we're in some innovative. It's always something that's out there.
New and exciting, and then 25 years. It's one of those books too, where it's like it aged very well, in the sense that the title only continues to make more sense. But I'll still point out, like Neil Postman, Amusing Ourselves to Death, is like mid-'80s. and it like describes social media in 2025 better than most things, and it's practically 40 years old at this point. I called this one. I was going to call it the Bernstein Bears in the case of the shiny new thing, but I think I'm going to go with Bernstein Bears and the case of the Haribo sugar-free gummy bears, because this is the danger. Are you familiar with the Haribo? I don't know how to say it. German company, I think, right? The sugar-free gummy bears. You familiar
I
with
have
this?
not, no. Do
This
you have
is
them?
a subgenre of literature. Don't have them is what you're going to find out.
Okay.
Go to Amazon, Amazon reviews, and look up the Haribo sugar-free gummy bears, and then save it for this weekend. This is a good weekend, maybe even a family activity. Let's just say the desired consequence of thinking these gummy bears look amazing and delicious, and they're sugar-free. A lot of people had a very specific biological reaction to these
Oh,
gummy
God.
bears.
Which we won't mention on the podcast.
But the idea is sometimes something is exciting, it's interesting, you chase in, you see a bunch of like positive reviews, or you see it for cheap on the airport, or you see it as a good thing to put out in a bowl before you have a date with a nice person at your apartment. And there's a lot of tragedy that follows not sticking to a strategy and staying away from things like Haribo sugar-free gummy bears. Rich is making this point. I'm being silly, but Rich is making this point.
Wasn't this Aswat the Motorin's lesson as well? It was something very similar, right? There's no way to get rich quick, and by doing that, you're going to cause more harm than good.
Yeah, do something you enjoy, and then just do it over and over and over again. If you know it's net beneficial over time, let the results compound slow. You'll be better, you'll be happier, and you won't be beating yourself up on your deathbed, which was also Professor Deveneron's point, if you just follow this simple path.
The hard thing about this lesson is it's very hard to teach it in the moment, and in the moment, you're an idiot. So, like, for me to say this is my lesson to you, like the person who owns the triple leveraged micro strategy ETF right now is like, what are you talking about? Like, I'm making a killing on this thing. Obviously, this is going to work. And like, that's just the way it feels like during these times. So you can't really you end up being the person who's not doing as well, who's criticizing the person that is doing as well. And they don't want to hear it because they're doing really, really well. So it's a challenging lesson to teach, but you do, at least if you think history is a guide, these things usually do end badly. So when you're taking these highly speculative bets, and I think we're in a world right now where maybe the ability to take those highly speculative bets is more than it's ever been, because we just seem to be, every time someone's like, I'm going to 3x leverage this in an ETF, someone's like, I'm going to 5x leverage this in an ETF. And it's like, they're competing to see who can leverage it more. And there's certain institutional investors who actually can use those things in the right way and do good things with them. But for your average retail person, it usually ends bad.
I love to remind people, and we've said it here a million times, it's that idea of like dogs that look like their owners. It's like investors or people who look like their advisors or fund managers or whatever else. And this is a good thing. This is a good thing to find people and professionals, and have professionals in your life that you have some type of shared values and aligned piece here for what you're trying to do. Because, and you, investor, know thyself. If you are prone to gambling or taking degenerate bets on things, that's okay. Find somebody who's really, really good at it, and then help learn from them or learn alongside them how to do it and not blow yourself up. Like if you love sports betting and options, like go talk to Andrew Mack or somebody like that. Get somebody on your side. But if you're not, like I know that's not my personality. I would be tortured to death by trying to do that kind of stuff. And so it's just like, I have to steer away from it. I have to go work on my Mango AI startup, not do this crazy other betting stuff.
And having said that, feel free if you want to write in the comments about how you've made, all this money in the triple micro strategy ETF and my steel stocks are not going up that much, or whatever I'm owning in my quant value portfolio these days. Feel free. The comments always help us. So we're always happy to hear them.
We're going to hear about a bunch of weird character and symbol, presumably cryptocurrencies, I'm sure anyway, right?
Well, we're certainly going to hear some automated comments about some, and I keep blocking every name of the cryptocurrency. And like every time the name of the cryptocurrency, it always starts with X, but it changes slightly every time, so that I can't and I don't want to block like the words Bitcoin, because I think there's like legitimate comments people could make that would include Bitcoin at some point in the comments. So not that anybody needs to know about this, but it's a constant battle for me against the AI things, and then obviously the three named financial advisors that only operate on Telegram. They're also a massive battle I'm fighting on a day-to-day basis, but I'm fighting it for you, the viewer. So hopefully you appreciate it.
I know they do. I know I at least do. And having seen some of these comments, yes, it's God's work, Jack. You're doing God's work.
Well, that's probably a good thing to wrap up on. Thank you, everybody, for joining us, and we'll see you next time.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Jack Forehand is a principal at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.